Okay, let's get started. Good afternoon, everyone. Welcome to this TradeStation webinar. It's exciting to have all of you here. Thank you for taking time out of your schedules to learn a little bit about options. Today, we're going to talk about beta hedging a portfolio, and we're going to do options. We're going to use options for that. We have our guest speaker, Brandon Wendell. He's a trader and a mentor, and it's great to have him here so that he can share his expertise with all of us. I think there is a special practical tool that he's going to share with all of us, and he's going to explain how to use it. And we're going to be sharing the links here in the chat to those tools and an article so that you have all the resources necessary so that you can do precisely that, which is hedging your portfolio. For those that are new to our series, my name is Jesus Nava. I head up the education team right here at TradeStation Securities. Always a pleasure to be here. I am going to go through some of the disclosures and introductions and then pass the microphone over to Brandon. But just keep in mind that every symbol and idea that we talk about is for educational purposes only. TradeStation doesn't do any sort of recommendations. And we all need to be aware that trading online is risky and that past historical performance is no guarantee of future results. If anybody needs additional information on the disclosures, go to tradestation.com/important dash information. All right. Here's a bio for Brandon. I'm going to let Brandon go over some of the highlights of his career, but it's great to have him here. He has years of experience trading the markets, especially options, which is the highlight of today's presentation. So let me go ahead and stop my share, and I'm going to mute my microphone. Brandon, thank you for joining us today, and the floor is all yours, my friend.
All right. Well, thank you very much for having me. Appreciate it, Jesus. Let me see. Go ahead and share my desktop, which pretty much has the almost the same version of what you were showing. My name is Brandon Wendell. I want to thank TradeStation for having me. I'm not actually an employee or affiliated with TradeStation, but I've just been invited to share some of my knowledge with you guys. So I want to go ahead and do that. As Jesus mentioned, I'm a full-time trader and mentor of trading. I was a chartered market technician, which is a master's degree in technical analysis. So I've learned pretty much all the different types of analysis and indicators and theories about the markets. I try to keep it relatively simple. I specialize in options and futures. And you probably see me in the options replay program as well as options replay for futures as well. So I do specialize and do trade those on a regular basis. Anyway, that's enough about me. I'm going to go ahead and jump into the presentation here because that's pretty much what you're here for, not me individually, but we're going to talk a little bit about beta weighting and what it is, and more importantly, how you can use it to affect some protection, potentially protecting your portfolio. Whether you're a short-term trader and worried about just a couple of hiccups or movements in the markets based on some sort of situational news that's coming out or whatever it may be, or you're a long-term investor and you're worried about, again, long-term protection of a portfolio to make sure that what you got invested doesn't go away. We hate to see during times of volatility, which we've been having quite a bit of more recently, times of volatility cause turn downs in the markets, and that could be turn downs in your portfolio. So what we're going to cover is, first of all, what the heck is beta? And that's a Greek letter. Most of the risk measurements when it comes to options are covered in Greek letters. You've got delta, theta, gamma, rho, delta, vega, which technically it's kappa they use, which is Greek letter. We're going to talk about beta. So we'll see what that represents in the markets and why do we want to even worry about this whole beta weighting our portfolio. And we'll talk about how you actually do it. So the rationale behind it, the effectiveness of it versus hedging other ways, and how we can maximize our protection using ETFs or using index options, what we can do to help protect ourselves, again, when it comes to our portfolio. So we'll go through the mechanics of beta weighting, and there's a neat little thing that's going on as well with TradeStation. They've decided to create something called the Options Education Center, which if you go to tradestation.com, you can go to the Learn tab and the Options Education Center. When you get there, if you scroll down just a little bit, there are different strategies. And one of those right now on the main page here is beta weighting. And that kind of accompanies what we're going to be talking about today. So if you click on Learn More, you'll actually get the link right here. I can copy it and put that into the chat for everyone as well. There you go. And basically, there's a video, there's an article PDF, and there is something cool called the beta hedging calculator, which I'm going to go ahead and talk about as well and show you a little bit about how to use that to, again, figure out what's going on in your personal portfolio and how you can try to protect it. Again, nothing's foolproof, nothing's 100%, but we do what we can to minimize risk. We can never eliminate it. If you eliminate risk, you eliminate rewards. period. So we need to figure out, okay, what kind of risk are we able to tolerate? And therefore, we will get rewards commensurate with that risk. So we'll talk also a little bit deeper. We're going to go into what's called beta weighted delta hedging. And it's one thing to beta weight the portfolio, but another thing to hedge it properly, you need to actually delta weigh or beta weight delta hedge your portfolios. I know it's a mouthful, right? It's actually not as hard as you think. And the neat thing is the calculator actually helps you with it as well. So, first of all, what the heck is beta? Beta is a measure of sensitivity against the market benchmark. And usually it's referring to the S&P 500 index. And every security that is traded for the most part should have a beta. Or the matter of finding it is one, it's another thing. The nice thing is on TradeStation, beta is one of the radar screen columns that you can create to be able to see in your portfolio. If you put it into the radar screen, you should be able to see the beta of each individual holding. And there's some tools in OptionStation Pro where you can actually beta weight individual portfolios, if you will, against different securities. It doesn't even have to be the S&P 500. It could be an ETF like the Qs, or it could be the spiders, the SPY. So basically, if it's like I said, it's a relationship. It describes a percentage of movement versus whatever it is the benchmark happens to be. Like I said, normally it is going to be the S&P 500. So if you have a beta of 0, as you can see on the chart there, that means you have absolutely no correlation with the S&P 500. And but typically, if we're looking at investments, we want 0 beta or 0 delta, even where one investment has no relationship to the other. In reality, most stocks have a positive correlation with the market. They move with the market. They may move slower, they may move faster. The higher the number of the beta, the more volatile the security is. If you have a negative beta, it means you move in the opposite direction than the market. And again, the lower the negative number, the more volatile that security is in the opposite direction. As an example, if you have a beta of 1.25, 1 is basically you have the exact same correlation as the S&P 500, the same volatility, same price movement. Now, betas do change. You got to keep that in mind. They're not static. Markets change, stocks change, personalities change of those based on earnings and people's perceptions of those securities. It's interesting because we don't actually trade stocks, we don't trade options, we don't trade futures. We trade people. And when you think about it, that's really what we're doing. We're trading people's perceptions of those securities. And those perceptions cause actions to be taken, buying or selling, and that causes price movement. That's really all it is, supply and demand based on what people perceive about a particular security's value. So anyway, if we have a beta of 1.25, that means that particular security is 25% more volatile than the broad market, the S&P 500, and it should move 25% more in the same direction that the market's moving. As I mentioned, you can have negative betas. And if you have less than 1, you move less volatile than the broad market. So in the case of a beta of 0.8, you are basically 20% less volatile than the broad market. If the broad market moved 1%, you would move basically 0.8% in the same direction. Now, one of the things you got to realize that higher beta means more volatility. And with more volatility is more price movement. So you get more risk and you get more reward. As I said before, reward and risk are hand in hand. You can't have one without the other. A lower beta is a more stable correlation. And usually it'll try to mimic the broad market. High volatility is high betas, low volatility is lower betas. And I mentioned negative betas move opposite. So you can have an inverse ETF, SQQQ, something like that. They'll move opposite of the broad market. They will have a negative beta, depending on whether they're a one-time or multiple of those leveraged ETFs. They may have higher betas because not higher negative betas, that is. Technically, it's a lower negative number, not higher, but it's higher when it comes to volatility. Anyway, just recognizing some of these names coming through here. Looking at some names I haven't seen in a while. Hi, everybody. Anyway, understand the beta does tell investors basically how, if you were to add a particular security, the beta may tell you how it's going to affect your portfolio. You know, if you have a high beta that you're adding or a very low number negative beta, like a negative 2.5, that'll move very fast, very volatile. As a matter of fact, 150% more volatile in the opposite direction of the market. So it gives you an idea of what you're getting into before you actually enter that position if you check the beta. And beta is not predictive, by the way. I said before, it does change. It shows you what has happened in the past with the particular security that you're looking at. So beta will change as the markets change and as the individual securities change. Why would we even care about this? What the heck is this whole beta weighting thing about? Why am I wasting my time with it? It basically quantifies systematic risk. And systematic risk, again, if you've got betas that are positive, you can't eliminate all that risk through diversification because it's systematic. It's throughout the entire system or the entire market. So a lot of people try to diversify portfolios and they don't realize that they still have all positive betas. And therefore, when the market crashes, all of their securities go down. Some of them just happen to go down slower than others. And we can figure out how much risk we're actually having in relationship to the broad market by knowing our portfolio's entire beta and weighing it properly. We can also, as I said, protect it potentially by using options to offset some of the losses we might incur when the market moves. So during market volatility spikes, I said before, everything goes down. A big example of this, I don't have a picture of it, but if you take a look at the sector rotation model, basically when the markets crashed in 2008 and in 2000, basically everything went down. The big market crashes took all sectors down. People think about defensive sectors like the consumer staples or healthcare or even utilities. Those go down too, but they may go down at a slower rate because they're lower betas. So again, it's systematic risk. You can't do anything about it other than trying to hedge. Diversification does not work to protect you on that case. But when you do beta hedging, we can use index options or futures or even futures options to offset portfolio exposure, meaning what we're losing in our portfolio, we can make up in the other investment. And you might be able to do this inside of a self-directed IRA, perhaps, or maybe you just have to do it in a taxable account and deal with the consequences. But the consequences of the taxation may be better than taking an overall loss and a drawdown in your personal accounts. By the way, I'm not a tax professional, so I can't give advice on that. But what I can do is talk a little bit about this beta weighting and how we actually go about doing it. So as I mentioned before, if you go to that page that I put in for the link and scroll down a little bit, you'll see there's a beta hedging calculator. And you can download that beta hedging calculator. And originally just had beta hedging, but it's actually added in the extra pieces. And let me see if I have it open right now. I should. Is that the right one? Yes. So here's an example of it. And there is the calculator that show up in the first part, as you'll see here. I can zoom in on it in a little bit. You basically will fill out the light shaded spots with your portfolio information. And you'll need to know the symbol, obviously, for personal tracking information. Even the mutual funds you might have in your portfolios have betas and they have symbols. You'll put in the number of shares you own, the actual current price. And of course, if you have the TradeStation radar screen, it makes it a lot easier. You just look that up by putting everything in the radar screen. And I can show you in TradeStation, I happen to have a watch list shown right now, not a portfolio, but if I were to go in under studies and add a study in TradeStation. Sorry, my computer is running a little slow. It's not TradeStation. It's definitely my computer. I'm running a bunch of things around here. But you see, there is beta under indicator, and I can add it in. I'll move it up a little bit here next to the last price. And there are the betas for the S&P 500. Some of them are low. AbbVie has a beta of 0.36. Let me see. Do I have? There we go. We can zoom in a little better. For instance, AbbVie moves a lot slower than the broad market, doesn't it? 0.36, that would suggest that we move at about 64% 64% less volatile than the broad market. That's it. So the broad market moved up 1%. AbbVie would still move positively with it, but it would only move up 0.36% compared to Accenture or Adobe, which is highlighted right there. Adobe has a 1.53, which means that it's 53% more volatile than the broad market. So it'll move in the same direction as the broad market, but it'll move 53% faster overall. So again, the tools are there. And if we go into OptionStation Pro as well, you have some tools there. So if I were to go into my manage page right here, you'll see that, that's weird. I think I'm getting an error. Yep. Oh boy. That is going to stink. Okay, we got to do this real quick. It happens with my computer sometimes again. I just have to reopen it and it'll reset. It's not a big deal. But basically, there is a beta weighting button up here. And the nice thing is you can actually change it to a different security. It doesn't actually have to be the S&P 500, you can change it to beta weight against an ETF, as I mentioned before, or another individual security. So let me go ahead and select this real quick and the task. There we go. And we'll go again. It should work just fine. It happens when I'm leaving it stagnant sometimes for a little while. Like I said, I'm running a bunch of different programs going on here. While that boots back up, switch over. And inside the calculator, there's also instructions, of course, because you need to learn how to use it. So you got the worksheet instructions. It talks about what's there and some information about it. And of course, I also wanted to give you an example. So there is an example of just a random portfolio, just selected some random securities. Doesn't really mean anything. It's not anything anybody particularly holds. Apple, Chevron, and a few others. And these are mutual funds. Usually when you see the X and 5 letters, you're looking at a mutual fund. These are definitely funds. The symbols, again, not as important, but the number of shares and the current price, as well as the beta, the individual beta for each of those securities. And we're going to use those in the calculator to weigh out our portfolio and beta weight it. So again, this is where I was looking at Option Station Pro. There are the positions. And right here, you can do beta weighting. And you'll notice it shows delta beta. We're going to talk about what that is in a little bit. So, like I said, basically the way to do this, you can do it manually, but it's so much easier with the calculator. What you're going to do is you're going to get the individual holdings. I took the picture of the sample there, how many shares you happen to own. And then in a radar screen or whatever, you can look up the individual price, the current market price. Obviously, when the markets are open, that'll be changing. It's a minor difference unless there's a huge move already happening. So it may be easier to do this when the markets are closed because the numbers may not be changing as quickly or at all. Once you do that, you get the beta for each individual security. And what the calculator is doing is figuring out the market value, your entire portfolio value based on what you add in each of those columns. Once you're finished, it'll also give you the weighting of each of those individual securities in your portfolio. So we can see that Tesla, even though they own more shares of this mutual fund, the price is relatively low. Meanwhile, Tesla's percentage is much higher, it's 30% of their entire portfolio because it's $56,000. Meanwhile, this 2,000 shares is only 20,000 or 11% of their entire portfolio. So we get that portfolio weighting multiplied by the beta, and we're going to get our weighted beta for that particular security. We're just going to sum together those weighted betas. Again, the calculator will do that for you. I'm going to go to the sample here and scroll down. You can see adding together the entire market value. We have the entire value of their portfolio, just under $200,000, 100% weighting. It has to add up to 100, of course. That's the number of shares they actually own of everything. And the portfolio weighted beta is 1.44. So the portfolio beta value is nothing more than the value of the actual shares in the portfolio times that beta. And that's what you actually have as far as risk. Even though this person only owns $185,000 worth of securities, it's a mix of mutual funds and stocks, they are actually having $267,000 of real risk in their portfolio. The other thing I put in with the calculator when it was created is this: you can decide not to hedge 100% of your portfolio. When you do 100% hedging, that means you are delta neutral. If the markets go up, if you do a hedge, it's going to lose just as much as you're gaining. If you do less than 100%, that might be a little bit better because now you have some upside potential in case it does go in your favor, but you're now protected to a certain extent on the downside. If you're really scared and you're worried about the market, absolutely, you're sure it's going to crash, yeah, you may want to do the 100% hedge because then if the market does go down, you are completely protected. However, like I said, the downside is if the market goes up, you don't get to participate anymore because you are going to be losing on your hedge equal to what you are making on the underlying securities. So you got to make some decisions on this. It's not done for you. This is just a tool to help you when you make those decisions. So again, you can go into radar screen. I actually just showed you how to do this and add beta into one of the columns and put in your portfolio right there. And you can see the individual betas. Now, when you're dealing with some mutual funds for your personal holdings, perhaps in your retirement accounts, you may not be able to find the betas there. You can usually find them online with some sort of financial website. I happen to use Yahoo Finance, for instance, and looked it up. And when you look it up, you'll see beta. It'll show you what the beta happens to be. It's usually an average over several years, and it's usually a monthly average. So you can go ahead and, again, look them up, whatever you have to do. This happened to be BPTIX, Barron Partners, and it had a beta that is 36% more volatile than the broad market. Let's see. So again, yeah, either you can put it in the radar screen or individual websites. And the hedge ratio, I mentioned it already. Like I said, the calculator does everything for you, but a lot of people want to know what the heck is the actual formula. There you go. So your portfolio value, again, just adding up what the current market value is for your securities times your portfolio beta. Once it's been calculated, you have to weigh out the actual holdings, and that's what the calculator does. And that's your beta weighting of your portfolio. That's how much value you have at risk in comparison to the S&P 500. Then to hedge it properly, we need to know how many securities do we need? How many options do we need to buy? How many puts? How many calls? Are we buying puts on the index? Are we buying puts on SPY? Whatever it may be, you take the underlying value of that index. In this case, we're using the S&P 500 index multiplied by 100, and that'll be our hedge ratio. So as an example, if you happen to have a $250,000 portfolio and it turned out your beta is 1.34, when the spiders, if they were using the spiders in this case, they were happen to be trading at 660. So you just do the math. And in this case, you wanted to round. If you round down, you're going to be a little under, which is not bad. Again, it may not be 100% hedged, or you may not even want to hedge 100% of your portfolio. Perhaps we only hedge $200,000. You could just do that. You substitute the 250 for 200 or with 200 and do the math. So in this case, it'd be 5 SPY put options, which would represent 500 shares of SPY to hedge this portfolio systematic risk. Now you have another thing you've got to figure out, and that's going to be which strike price to use. Now we're going to cover that in just a little bit as well. So the nice thing is, as I said before, the calculator tries to make your life a little bit easier. What you will do is you'll put in the strike price that you want to use. So that's the price right here. The index value, it says, that's actually the strike price you're going to be selecting. So in this case, we're using 660 as the at the money strike, or perhaps it's a 5% drawdown. Again, your risk tolerance is going to be your decision. If you're okay with a 3% drawdown or 10% drawdown, maybe you don't want to get in with a hedge until the markets are officially in a bear market, 20% drawdown. You might want to protect before that, but who knows? You put in that strike price and it will give you a number. And you can see that it's currently set up for SPY, SPX, which is the index options. And if you have a smaller account, but still want to use an index option, you can actually use the XSPX, which for TradeStation, and again, you can just type these in. You'll see the symbols. I actually have XSP or XSP. That's the mini SPX options. And we can use those for a hedge. They're almost identical to what you're going to be seeing with the SPY. The difference between the two, with the SPY, you have American style options, and with the index options, you get into the European style where you don't have to worry about early exercise, or you cannot exercise early. You get some limitations. You get a little bit more freedom when it comes to the SPY, perhaps. If you have a larger size account, typically probably going to need close to 300,000 up to whatever, it doesn't really matter. That's when you start using the SPX full size options rather than the XSP. So the XSP, for most people, that'll be sufficient for hedging your 401ks, your IRAs, depending on how much currency or how much you have in those accounts. Again, so you'll get the numbers for all three of those, and you can choose which one you want. And again, you have to choose the strike price that you are going to use, and we're going to get a little bit more into that as well as how do we select those. So again, this is just showing an example. I happened to pick a bunch of different stocks and a few mutual funds here and just made up a person's portfolio. They actually had a market value of $246,000 total. They decided they're really worried about the market. It's a little bit more volatile. They're only 13% more volatile than the market, but they want to protect 100% of their portfolio. These were the current values of those securities, and I used strike prices at the money. So this would be an immediate threat where somebody does not want to have any drawdown whatsoever. Again, if you are okay with a bit of drawdown or don't want to do 100% portfolio hedge, the drawback is you hedge 100%, you don't participate if it goes up, but you are protected on this downside. And if you use strikes at the money, you are putting in the protection right away, not accepting any drawdown whatsoever. In this case, the portfolio turned out to be actually 279,000, we'll call it 280 versus 250. So the actual value is 250, but based on that extra volatility, you want to insure $280,000. That would take 4 SPY options, puts basically, buy the puts to protect. Can't really do the SPX because you can't do less than one option. If you did one option, you would be overhedged and actually profit a little bit from the downside move. And the same thing with XSP, the minis, you have the 4 as your choice. If you showed up with maybe 4.6, 4.7, once again, if you round down, you'll be underprotected. If you go above and round up, you have extra protection, which means you might actually make a little profit when the prices are moving down or the markets are dropping. So in this case, we had, or I went back here, 4.1 for SPY, or did I use XSP? Nope, I use SPY. And you see the quantity is 4, using at the money options, buying the 685 put for 22.17. I think it's set on the mid price, which is actually 22.14. And in this case, here's the thing. If the portfolio drops, let's say the markets drop 5%, okay? If you're hedging a beta of 1, this risk would be the same as a SPY. Yes, if your portfolio is 1, it would be the exact same as the S&P 500. Not the SPY, but the index. Okay, and that's the difference. The SPY is share and is not the same as the full index. So that's why when you're looking at those, you have to beta weight. And we're actually going to have to do one more thing. Just watch this. Doing this particular hedge, if the portfolio dropped 5% because the market dropped 5%, that portfolio would lose $12,000. However, the hedge, as you can see, only made $6,600. It didn't cover it right. Wait a minute, we tried to do 100% hedge, didn't we? What is going on here? Think about it. When you buy an option at the money, the delta is going to be right around 0.5. That means for every 1 point the index drops or the broad market drops, your put is only gaining half of that, or in this case, 45% of the 1 point. So you are not hedged 100%. So we have to do an extra step here. Remember, true hedging is delta neutrality. When you eliminate delta or neutralize it, you are basically removing directional risk. Remember, each one of those Greeks stands for a different kind of risk. Vega is volatility, theta is time, D, delta, direction. So we have to become more delta neutral. We beta weight to know how much we are needing to protect, but we need to be delta neutral in addition to that. And here's the other kicker. That is going to be dynamic. It's going to change as markets change, because the deeper you go in the money with a put, meaning prices of the underlying security drop, what's going to happen with your delta? It's going to increase, isn't it? Or in this case, it's going to decrease closer to -1. The deeper in the money, the closer it gets to -1. So you can actually take off some of the hedge or need to possibly add some of the hedge depending on what happens with the underlying market. So we're going to have to do a beta weighted portfolio delta now. And again, it's not that hard. And we added that in the calculator as well. So with the delta, beta weighted portfolio delta, there's the calculation if you care. It's going to be the portfolio value times a $1 move in percent of the hedging security times the portfolio weighted delta. It was fun putting together that spreadsheet, let me tell you. So using that previous example, once again, we figured out that the portfolio had a value of $246,000 roughly. And the SPY was about $683 at that time when I did that recording. A $1 1 point move on the SPY when it's valued at 683 is 0.0015%. And the portfolio's weighted beta, as we saw, was 1.13. Again, 13% more volatile than the S&P. So plugging in all the numbers is basically telling you how much the portfolio would lose for every $1 the SPY drops. In this case, that particular portfolio with its volatility and what it contains, every time the SPY drops by $1, that would lose $418 of value. So we need to weigh it out that we're making that much in the options. And this is how we do it. The beta weighted delta divided by the delta of the option you use times 100 is the number of contracts you select. Again, if you take a look at the calculator and scroll down to the very bottom, there's added pieces here. We so far were looking at the strike prices we wanted to use, but if you put in the delta of the option, it automatically calculates the shaded areas for you. So your beta weighted delta is already calculated. It'll spit out how many options you actually need. So instead of 4 in this case, now this wasn't the same portfolio, but this one is 8.5 Again, you could round down to 8 and have a little bit extra exposure, or you could round up to 9 and have extra protection. This is assuming you're using an at the money option. What if you decide you want to go a little less and perhaps spend a little less by going to an out of the money option? You would just simply change the delta of the option you choose. I think I have an example of that rather than going through all this. In this case, yeah, the 418 divided by 0.45. Again, that was the delta of the option times 100 is 9.25, or we round down to 9. So basically, if you use the 685 puts with a negative 0.45 delta, you would buy 9 puts to fully hedge. And that's why the calculator is so helpful, because trying to do all this math step by step becomes a little onerous, and it's much, much easier if you do it this way. Remember, prices of the underlying security is going to change. The market is going to change. The deltas are going to change on the puts. And as the market drops, when those deltas go up, you will not need 9 puts. You may end up being able to close out some of those puts as the delta grows, and you have additional protection from what's left. Maybe you end up with 6 or 5 puts, depending on how far the market drops. You can actually do this by looking at the price slices in OptionStation Pro. By using those price slices, in this case, you can see now, remember, if we lost 5% on that $250,000 portfolio, that's about 12 grand. In this case, I didn't adjust it. I basically kept the full 9 contracts the entire time. Moving the price slice down, you could see that hedge provided $15,000 of protection. And you don't have to give up your portfolio. You simply would be able to sell the options for a profit when the market is looking like it's going to recover. Or again, you could sell some of the options on the way down and recoup some of the losses and still maintain a decent hedge, because the deltas of the puts will increase as prices drop. And of course, you can experiment with different deltas. Going out, once again, if I go to, let's go to SPY, since I have that in the calculator already in the sample, and we'll go a little further out in time as well, because we don't need just 12 days of protection, most likely. Perhaps we want to protect ourselves for the next 3 months or so. Go out to the February options. And, oops, wrong one. And we have our calculator here. This is, I'll use the same portfolio that I had as the example, which has a little under $200,000 portfolio, but has a pretty high weighted beta. This is 44% more volatile than the broad market. So we need to protect, on an average, $267,000 worth of stock. Let's back this off a little bit. Let's say we're only worried about hedging about 80% of our portfolio now. First of all, let's figure out what strike we want to have. Going into the markets, right now we're trading at 680. Let's say we're okay with, let's say, I don't know, 5% drawdown in the broad market, right? I'm terrible at math, so don't shame me. I'm using my calculator here. So we're currently at 680, and if it draws down 5%, we're at about 650. Beyond that, we want to be protected. So let's say add a few more strikes. There we are. And we have the delta we'll watch for. Nope, still not there. We need more strikes. There we go, 650 put. So let's say we're going to use the 650 put for our hedge. That 650 put is out of the money, right? It only has a delta of 0.27. So it's half as effective as an at the money put, a little more than half for a hedge. But we could still use that. So I would go ahead and go back, put in the strike, 650. You don't have to fill out all these. It is in the example, but you don't have to. So that's the strike. The current SPY price was what, 680.43. And the delta we were using is 0.27. I'm just going to use the positive for it. It doesn't matter. That means I need roughly 11.6 to hedge 80% of my portfolio using that 650 strike price. Let's take a look. If we go to 11 of these, I'll round down to 11. It was actually 11.6. I could round up, but I'll round down. Remember, we have a portfolio of $185,000 right now. And if that portfolio were to drop, let's say 10%, that's $18,000. We'll make it a big swing, actually. $18,559. So we need to make sure that we're making about that. Again, we're only hedging 80% of that, not 100%. So we're going to be needing to make about $14,000, we'll call it $15,000 in profit as this moves down in order to cover that if this market moves down by the same amount. So if I go to analyze here, I might have some other positions already analyzed. Nope, I don't this time. That's good. Now, the other thing is going to be time, because we're not going to want to hold this all the way till expiration because we're going to lose time value. But if the market drops, again, roughly we said 10%, we're at 680. Oops, wrong button. That would be 612. Is that right? 612. I had it almost there. Now, this is at expiration. As I said before, we're not going all the way to expiration. And I'll put it here. And you can see we are way over hedged at that point. Like I said, as the prices drop, we're going to be needing to unload some of that hedge because we only need $15,000, not $30,000 of protection. And that's going out from 107 days to now 53 days. So we're talking about 54 days have gone by and we were hedged, protected. And as the prices drop, like I said, you're going to have to dynamically change this because you're not going to need as much. Remember, as the markets are moving down, that 650 put in this case is actually going to go in the money and go way beyond 0.5 on the delta. So you'll be able to unload some of those 11 along the way, lock in that profit that automatically covers some of your unrealized losses in your portfolio, but you are protected. And that's the right way to hedge the portfolio to make sure you actually are protected. So how often you need to check this and reweigh it, that's going to be up to you, but probably at least once a week. I usually look at investment portfolios maybe on the weekend, on a Saturday, Sunday, depending on if there's how many games are watching on Sunday football, but it's up to you when you want to do it. But it doesn't need to be done every single day. But as you can see, as prices move further down, the hedge will grow stronger and stronger as the deltas increase. But that's what you're needing to do to make sure that you actually have the delta weighted drawdown to cover your portfolio. So in this case, as you saw, you didn't draw down nearly as much, but we covered a $12,000 drop and made $15,000 to cover it. That's the expensive hedge. Again, it depends on how long you're going to need that. The hedge cost, $13,000 to get into that. But remember, if we end up liquidating this, there's still going to be value. That's just your deposit to get in. You're not actually spending that much. That's one of the things you also want to take into consideration is the time decay of your option. That's why I didn't go all the way to zero. I typically don't want to be long an option when there's 30 days or less until expiration. And what were we insuring? It was a $180,000 portfolio. Yeah, we want to try to keep our costs around 5% or so. So again, maybe even less, 3% if we can, 6 to 8 at the high side. We were over 10% or about 10% in this case, right? No, what was it? I didn't see exactly what the number was. 13,728 divided by, it was 185 by 92. We'll call it 185, 600. So that was 7.3% of your portfolio for insurance. So yeah, it could be an expensive hedge, but again, you're not actually spending that entire amount. If you were to liquidate that option at the time that you no longer need it, remember the time value is still going to be there for you to recoup a lot of that cost. Plus, if it goes in the money, you're going to have an intrinsic value with a profit for your hedge. So you're not actually spending the full 13,000. Yes, it's tying up some capital to be able to pay for that hedge. We could choose a different option. We don't have to go that far down for the drawdown, and we may not need as many options. We again change this around. And that's why the Options Station Pro with the experimenting with different numbers really benefits you. I'll keep that one there. Take it off the analysis though. So instead of that big of a drawdown, maybe we don't go as far out. We can always roll our position as well by creating a new hedge and getting out of the ones. Remember, if we do, let's say, I'll keep the same time. Why not? But we'll do a different option. So get rid of that one. That's not doing it. I'm going to do it this way. Maybe we do 670. Get rid of the 650. And we have a 0.37 delta.
Listen.
670. And we've reduced it down to 8.5. We could also use the options on the index as well. Remember, that might be a different opportunity. Sorry, this is 8.5. So we'll do 8. And actually, the cost is still about the same in that case. Because again, you're doing that portfolio beta and trying to hedge 80% of that. So using different ones, you're just adjusting and adding more for the lower delta, subtracting contracts to do the higher deltas. But you're still looking at around 6 to 7% cost of your portfolio to protect that much. You do not have to protect 100%. The calculation for the portfolio beta, again, is in the calculator. It's simply weighing out each of the betas based on portfolio weighting. It gives you the weighted beta. And if you go back and watch what I did in the videos, which this will be available online as well in the TradeStation Education Center, you'll see I showed you the actual calculations there a little while ago. I'm not going to go back through them all again, but the calculator does it all for you. So again, If you're long puts as a write-off, I don't know. Again, you'd have to talk to somebody about that. You can also buy puts. Oh, what is this? Somebody's asking. Let me see what I have here, question-wise. Oh, just to understand, you want to buy put in more than 45 days. Personally, I prefer longer than that. And the reason why is when you get to 30 days left in the expiration, you're going to have a nosedive in theta. It's a huge, nosedive in the time decay. It's going to become exponentially greater. And I want to avoid that. I typically want to be liquidating those hedges when there's at least 30 days left until the expiration of that option. I can always roll it into a new position if necessary. But once you go within 30 days till expiration, you're going to lose so much time value that your hedge becomes more and more expensive. So the actual cost, as I said before, is not going to be that $13,000 for that hedge because you're going to liquidate that position maybe with 45 days, maybe 30 days left until it expires, or even sooner if you need to, or you don't need the protection anymore. If we've gone through the troubled times, we're back into the bullish markets. So you're only going to need to hold just as long as you need that protection. So I said before, you could weigh it out by going to a different expiration, say 72 days. They were protected over 2 months right now. Although, again, I want to get out when there's 30 days or more left. So maybe I go in between there, but I could still choose the 650 option. I still have the same delta, and I just weigh it out to see how much it's going to cost me by using the calculator. So overall, beta is just a measure of how your portfolio is, or individual securities are, for volatility versus the broad market. And I have no idea if you buy puts at a cost of doing business. I don't know if that would work that way. You'd have to talk to your accountant, but I don't believe so. It is a position you're putting into the markets. You can use beta in radar screen or find betas for your individual securities in the radar screen, as I said before. And you may have to go to websites to find some of them on the mutual funds individually. You can use the beta weighting calculator to simplify your life because, again, that will calculate not only the beta portfolio of the portfolio, but the delta hedging that you need in a number of contracts to actually hedge your portfolio. Keep in mind, though, this number will change because these deltas change the deeper that option goes into the money. And you can theorize and play around with the OptionStation Pro to figure out how you want to go ahead and hedge yourself and how you may need to release some of that hedge in order to maintain that delta neutrality. Because we are using this to protect ourselves. We're not using this to make money. So we want to make sure. That's why I was saying round down rather than round up, because we're not necessarily trying to profit. If you're trying to profit from a downward move in the markets, there are other strategies that will work much better for you for that. To adjust the hedge, like I said before, it depends on how much movement you're getting. Every week is what I usually try to do to peek in and see what's going on. Some people do it once a month. You could actually do that once a month and still be okay unless there's a really sharp move in price within the month.
Fast, clear,
So I
disciplined.
would say maybe if the market's moved by a few percent, 2 to 3%, you may want to reevaluate or just have a set schedule once a week or once every month to pay attention to your portfolio and to check that hedge. Okay. Calls, puts, and stocks are treated the same from the tax point of view. Yes, unless they're the options on futures, which you can also use as a substitute for this as well. And again, you could use the calculator to calculate those out as well. Just substitute those numbers for the hedge and figure out if you want to use options on the S&P futures, or if you have a tech heavy portfolio, perhaps you want to substitute the NASDAQ. If you have a lot of small cap companies and you're really only investing within the United States itself for your investments, perhaps you want to use the Russell 2000. You could use the IWM or the Russell 2000 options. So again, you can go ahead and use different securities, but the main thing is you need to know about that hedge. Again, the cost of the hedge, you can adjust it based on the months and how far out you go. Typically, you want to try to keep it around 3 to 6% for the cost. And I'm not necessarily talking about how much money you're tying up initially to get into the hedge, but when you exit the hedge, like I said before, when you're buying puts, you want to avoid that theta time decay and typically liquidate your position before there are 30 days left until expiration. So that way you'll recoup a lot of the time decay. You'll have a minimal amount of time decay. For instance, in the options we were looking at here, going to 72 days, our theta is about 11 cents on those out of the money puts. When we went to, it was 107 days, February, we dropped a little bit there to 9 cents. So we have a lot less time decay percentage wise when you look at it for a little bit longer out.
Targets set, stops set, total risk fits my plan, sending it.
Jesus, your mic's still on.
Sorry about that.
That's okay. Anyway, like I said, you can go ahead and choose your hedging security and strikes that you are comfortable with for the amount of drawdown that you're comfortable with. So calculate if you just want to suffice with a 5% or 3% drawdown, or if you're willing to take more. That's also going to play into the account or how much you're spending for percentage wise in your account. But strive for, like I said, to keep it around 3 to 6% on your individual portfolio. And you just have to go ahead and play with the different numbers using the calculator and Optimization Pro to get in that amount that you actually are comfortable with. And it should, in theory, be, like I said, right around 3 to 6% to be comfortable in using that. And if you have a leap, like a 14-month option, would you close a year or after a year to get time value? Volatility tolerance. Again, is if you're worried about just a large crash, then yes, you may want to go much deeper out of the money. But the deeper you go out of the money, the less delta you're going to have. And therefore, you may need a lot more contracts in order to make up for that large drop. So you have to weigh that out for the pricing. And obviously, yeah, you definitely would like to be able to do, oh, you're saying out of the money hedge to get dry powder. So basically, you want to earn a little bit when the market goes down. So that way you actually have extra money to purchase those companies that are on sale. That's possible. If you do not adjust your hedge, you're actually going to have that because as the market drops, you're hedging based on the deltas where you are right now, not on where the deltas are going to be once they go deeper in the money. So if you do not adjust your hedge, if you're comfortable with the amount of money you're spending initially and you're exiting those puts when there's after a year, again, you still have 2 months left until expiration. If you did 14 months, then you're going to have a big kitty, if you will, to be able to buy those companies that are on sale. That's a possibility by not adjusting. So that's a possibility that you can do as well. And again, go deeper out of the money as well. The problem is, again, how much it's going to be as far as the delta. You may have to end up loading up a lot more contracts because your delta may be what, 0.15 when you go that deep out of the money, depending on how far it is. Is it less costly to buy VIX calls? I honestly haven't played with the VIX calls because the volatility spike is a little hard to anticipate as well. Yes. I've just done because again, beta itself is usually a measure against the S&P 500. So that's why I typically have stuck with S&P 500 index or derivatives from that, either the futures or the SPY, which are derivatives of that index itself. Because the beta technically measures your portfolio movement versus that S&P 500. But as I said, yeah, the VIX is actually, in a way, it's the investor fear gauge of the S&P 500 for the next 30 days. You're looking at the volatility there. So could you do that in inverse and buy the calls? Yes, you could. I don't believe it'll be any less costly, especially when you end up dealing with the deltas and trying to weigh out and become neutral in the position. But that's something that you could try by looking at the calculator and with Optimization Pro and price it out by all means. I just personally haven't done it. So any other questions? Let's see, random off topic. Unusual options activity? No, not as much. I'm sure there's probably a lot of positions that are interesting things that come up, but I try to keep my life as simple as possible and not get too involved in too many things. Obviously, I want to protect my money if the market happens to go against. So that's why we talked a little bit about how to do that and use these things. But as far as no, get a little bit off that now. As far as the recording, yes, there will be available because I know I went over a lot of information here. And again, the calculator as well as the recordings will be in the Options Education Center on TradeStation.com. So you'll be able to go there under the Learn tab is the Options Education Center. And once you go in, you'll actually see, I'll just go back through the steps. And I think we put up the link earlier, but I'll do it again, no problem. So this is the Options Education Center as a whole, which has a lot of different strategies you can scroll through and see, learn individual strategies if you're interested. We also have wealth protection and a little bit of market volatility, but this is the one we're talking about today, which is, again, beta and actual market risk. There's a video. The workshop will be posted here as well eventually after it goes through a little bit of review and editing. And as I said, you can scroll right here. Beta hedging calculator is also on that page. So let me do this once again for you. Copy, and you can find the calculator right there. Okay. Any other questions? I think we're almost out of time here. I actually stuck to the schedule for once.
That's great. I'm sorry about the microphone. I must have left it. I was just talking to myself. Good thing. I'm talking about trading.
That's a good thing. I want to
Yep.
thank everybody for being here, and I appreciate it. Hopefully, I was able to help you out with some insights into beta hedging and showed you where some of the tools are as well. Yeah. So thank you again, and thank you for having me. Appreciate it.
Thank you, Brandon. Thank you for your time. And thank you, everyone, for attending this webinar. Please remember to check our event calendar for upcoming sessions. We always do these type of sessions and we cycle through different strategies and different methodologies. And Brandon is a guest speaker for many of these sessions. So make sure that you check out the calendar for upcoming topics. Have a wonderful afternoon, everyone. Again, thank you, Brandon. Everyone, have a great night, and I'll see you next time. Goodbye.